Welcome, curious minds, to another deep dive. Today, we're plunging into the fascinating, ever-evolving world of a company that, well, profoundly shapes our digital lives.
hmm
Alphabet.
hmm
You might know them better by their most famous subsidiary, Google, of course.
Right, yeah.
From powering your searches to connecting you on YouTube and increasingly steering the future of artificial intelligence and autonomous vehicles, this company is just everywhere.
It really is.
Our mission today is to cut through the noise, to truly understand the core of its incredibly diverse businesses, its financial pulse, its strategic moves into the future, and, what its current standing suggests about its path forward.
Okay.
We're going to unpack what makes it tick and where it stands in today's dynamic, fast-paced tech landscape.
It's truly a monumental task to get a grasp on Alphabet, given the sheer scale and complexity of its operations.
Yeah.
It's so much more than just a search engine company now, even though that remains its, foundational pillar. Understanding this company, and indeed any entity of this magnitude, absolutely requires a comprehensive view of its multiple interconnected ventures.
Right.
Each of these ventures operates within its own significant market dynamics and faces distinct competitive pressures. So looking at it holistically is key to grasping its true potential and challenges. It's almost like observing a complex, self-adjusting organism rather than, a static machine.
That's a good way to put it. One of the first things to wrap your head around with Alphabet is its somewhat unique corporate family tree, revamped back in 2015 for a very specific reason.
Right, the holding company structure.
Exactly.
Yeah.
This restructuring was a deliberate strategic move designed to enhance management oversight, boost accountability across its many diverse divisions, and, perhaps most importantly, provide greater transparency to the market about its various ventures.
Yeah, that transparency piece was key.
It was. Essentially, this model allows for the distinct operation of Google, which remains its largest and most dominant business, alongside a portfolio of emerging technologies, famously known as other bets.
The moonshots.
The moonshots, exactly. It's almost like having a highly efficient revenue-generating core and a separate innovation lab exploring what's next.
Mm-hmm.
When we look at their financials, they report across three distinct segments. First, there's Google Services, which is the massive engine powering most of their revenue.
Okay.
Then we have Google Cloud, their rapidly growing enterprise arm.
Yep.
And finally, Other Bets, where the future is being cooked up.
Right, the long-term plays.
So let's pull back the curtain on Google Services first. This segment is really the enduring foundation of Alphabet. Think of it as the bedrock.
Definitely.
Responsible for over 75% of the company's total revenue in 2024.
Wow, still that high.
Yeah, it's an unparalleled ecosystem of products and platforms, many of which you probably use every single day, perhaps without even realizing they're all under the same umbrella. We're talking about global behemoths like Google Search, the Android mobile operating system that powers billions of smartphones worldwide,
Mm-hmm.
the Chrome web browser, YouTube with its endless stream of content, Google Maps helping you navigate the world, and the Google Play Store, your go-to for apps and digital content. It's just vast.
It really is an ecosystem.
The primary revenue driver for this segment, and thus for the entire company, is advertising.
Still king. Yeah.
Still king. This comes from several sources. Ads shown on Google search properties, those YouTube ads you sometimes skip,
We all do.
and ads displayed across the vast Google network of third-party websites and applications. But it's not just advertising anymore, which is interesting.
Okay.
A progressively important and growing revenue stream within Google services is what they call Google subscriptions, platforms, and devices.
Right, diversifying a bit.
Exactly. This is where things get interesting because it broadens their revenue base significantly. This includes consumer subscriptions like YouTube TV, which offers live television streaming,
Keeping track.
and Google One, which provides expanded storage across Google products, appealing to a sticky subscriber base. It also encompasses revenue from the Google Play Store, which takes a cut from app sales and in-app purchases, critically tapping into the massive mobile app economy.
The App Store cut.
And importantly, it includes sales of their own hardware, such as the Pixel family of smartphones, smart home devices like the Nest Hub, and other gadgets, allowing them to control the end-to-end user experience.
Yeah, the hardware play is becoming more serious.
It really is. It's a truly comprehensive and interconnected web of services that keeps billions of users engaged and generates immense value through various monetization channels, ensuring they're not solely reliant on just the traditional ad model.
Which is smart long-term.
But Alphabet isn't just about search, as we know. There's another engine firing on all cylinders: their cloud business.
Right, Google Cloud.
Let's shift our gaze to Google Cloud, which we can certainly describe as an ascendant powerhouse within the Alphabet portfolio.
Ascendant is a good word for it. It's really come on strong.
This segment provides enterprise-grade cloud services, catering to businesses of all sizes, from startups to Fortune 500 companies. Their offerings span the full spectrum, including infrastructure as a service, or IaaS. Think of that as renting the raw computing power and storage.
The basic building blocks.
Exactly, like renting the foundation of a digital house. Platform as a service, PaaS, which offers pre-built environments for developers to build and deploy applications, giving you the walls and roof.
Right.
And software as a service, SaaS, which includes popular applications like the Google Workspace Productivity Suite, encompassing Gmail, Docs, Drive, and Meet for businesses, essentially, moving into a fully furnished apartment ready to go.
Yeah, the whole workspace suite is pretty embedded in a lot of places now.
It really is. Google Cloud's strategic focus is incredibly sharp, especially in the current tech landscape. They're delivering AI-optimized infrastructure, which is crucial for the heavy demands of modern artificial intelligence and machine learning workloads,
Absolutely critical, yeah.
providing the muscle for the AI revolution. They also provide a comprehensive developer platform called Vertex AI, which allows businesses to build, train, and deploy their own AI models with powerful tools and pre-trained models, making advanced AI accessible to more companies.
Democratizing AI. Sort of?
Kind of. And increasingly, they're offering advanced AI-powered cybersecurity solutions, a critical concern for any enterprise operating in today's digital landscape.
Huge concern.
Positioning themselves not just as a cloud provider, but as an AI innovation and security partner for businesses.
What's fascinating here with Google Cloud, and frankly, a truly crucial turning point for Alphabet, is that it achieved sustained profitability starting in the first quarter of 2023.
That was big news.
Huge news.
Yeah.
This might sound like a simple financial metric, but the significance of this shift cannot be overstated. For years, Google Cloud was a significant investment area, constantly generating operating losses that weighed on the company's consolidated results.
Right, a drag on earnings.
Exactly. It was a long-term play, requiring massive capital outlays to build out data centers and develop competitive services, essentially burning cash to build market share. But now, it has transformed itself from that investment sink into a self-sustaining, high-growth profit center.
Quite the turnaround.
If we look at the key data points, the turnaround is remarkable. An operating profit of $191 million in Q1 2023, accelerating to a robust $900 million in Q1 2024.
Wow.
And then truly hitting its stride with a remarkable $2.18 billion in operating income in Q1 2025.
$2 billion. That's serious profit.
It's serious profit. This isn't just a slight improvement, it's a dramatic swing from significant losses to substantial profits, demonstrating that Google Cloud is now a powerful contributor to the bottom line rather than a drain.
Yeah.
The implications of this are profound. This improving margin profile is expected to become a material tailwind for the company's overall profitability, validating their long-term investment, proving the viability of their business model at scale, and supporting a much more positive view of the consolidated business. It shows that the initial heavy lifting is paying off in a very big way.
And then we have the other bets segment, which I always find incredibly intriguing.
The fun stuff.
Yeah, the fun stuff, the moonshots. This is where Alphabet houses its most ambitious long-term projects. These ventures are aimed at addressing major global challenges through pioneering technology, and they're in various stages of development. Some are still in pure research and development, while others are beginning to commercialize.
Right.
It's where they place their bets on future industries. Among these, the most prominent and by far the most advanced venture is Waymo.
Yes, Waymo.
The company dedicated to developing and deploying fully autonomous driving technology. It's a bold vision, attempting to redefine how we get around, one that could truly change our cities and daily commutes.
Waymo is indeed a fantastic example of a critical inflection point for Alphabet's other bets. For years, it was viewed as a very long-term research project, consuming significant capital with an uncertain commercial future.
Right, lots of skepticism.
Loads of skepticism. Many considered it a pure R&D expense, but it has undeniably transitioned into a rapidly scaling commercial business. And this represents a significant source of potential hidden value within Alphabet.
Okay, so what's the proof?
Well, the data is truly compelling. Waymo is now providing over 250,000 paid passenger trips each week.
250,000 paid trips weekly.
Weekly. Think about that for a moment. That's a 5-fold increase from the previous year, which clearly demonstrates strong product market fit and robust operational capability.
That's impressive growth.
It is. This isn't just testing. This is real-world, revenue-generating service, proving that the technology works not just in labs, but on real streets with real customers.
Okay.
And they're not stopping there. They have aggressive expansion plans. They're increasing service areas in existing markets like Phoenix, San Francisco, Los Angeles, and Austin, making their autonomous ride-hailing more accessible.
Expanding the footprint.
Critically, they're also preparing for launches in new major cities, including Atlanta, Washington, D.C., and Miami, signaling a much broader national footprint.
Wow, big cities.
And looking beyond the U.S., Tokyo is slated as its first international market, which is a massive step.
International already, okay.
This decisive shift from pure research and development to commercial scaling fundamentally de-risks the Waymo investment. Its viability is increasingly proven.
Right.
And the primary variable now is no longer if it will work commercially, but rather the pace of its deployment and how quickly it can monetize its services.
Speed of rollout.
Exactly.
Yeah.
This progress transforms Waymo from a speculative moonshot into a tangible business with a clearer path to significant revenue and, eventually, profitability. It's truly an eye-opening development for the company.
Yeah, that really changes the narrative around other bets. It's clear, too, that Alphabet isn't just a U.S.-focused company. Its global scale is immense.
Oh, absolutely.
International markets are actually a significant contributor to its overall financial health. For instance, in fiscal year 2024, revenues from outside the United States accounted for 51% of consolidated revenues.
More than half.
Yeah, more than half. Underscoring its worldwide reach and dependence on diverse economies. To break that down further, for 2024, the United States contributed 49% of revenues,
Just under half.
while Europe, the Middle East, and Africa, or EMEA, accounted for 29%. The Asia-Pacific region, APAC, made up 16%, and other Americas, including Canada and Latin America, chipped in 6%.
So EMEA is pretty significant, too.
Very significant. This truly highlights how much of their business activity spans the globe.
And this substantial international presence has important implications, particularly regarding exposure to foreign currency exchange rate fluctuations.
Ah, the currency effect. Wow.
Exactly. What this means for you, as someone looking at the company's performance, is that changes in currency rates can significantly impact reported revenues and profits.
Yeah, makes comparisons tricky sometimes.
It does.
Mhm.
Imagine Alphabet earns money in euros and then converts it back to U.S. dollars.
Mhm.
If the dollar strengthens, those euro earnings are suddenly worth less when reported. For example, in Q3 2024, Alphabet reported revenue growth of 15%. However, if you were to look at that on a constant currency basis, meaning without the impact of currency rate changes,
Stripping out the FX.
the growth would have been 16%. That 1 percentage point difference illustrates a headwind from a strengthening U.S. dollar, which makes international earnings, when converted back to dollars, worth less.
So it masked some of the underlying strength.
Precisely.
Huh.
So it's a relevant factor to consider because it means reported financial results can sometimes diverge from the underlying operational strength of the business. You have to look beyond the headline numbers to understand the true trajectory, almost like stripping away the noise of currency fluctuations to see the core performance.
Right. Need that constant currency view. Okay, here's where it gets really interesting, I think. Let's transition to analyzing the vast markets Alphabet operates within, because it's not just about what they do, but the size and growth of the sandbox they play in and how they stack up against the competition.
Context is crucial, yeah.
First, the global digital advertising market. This is Alphabet's bread and butter, especially through Google services.
Still the core engine.
This market is simply massive and continues to expand at an impressive clip. It's projected to grow from an already staggering $650 billion in 2025
Wow.
to nearly $1.5 trillion by 2034. That reflects a compound annual growth rate of approximately 9.5%.
Almost doubling in under a decade. Still strong growth.
Huge pie that's just getting bigger. creating a significant tailwind for Google's primary revenue source. Even in the United States, digital ad spending demonstrated robust health in 2024, reaching $258.6 billion, representing a significant 14.9% year-over-year increase.
So healthy growth even in mature markets.
Definitely. We're seeing some key trends shaping this industry that are worth highlighting. There's the rapid growth of digital video advertising.
YouTube territory.
Right, up 19.2% year-over-year in 2024, reflecting the dominance of platforms like YouTube and the increasing consumption of video content. We also see the rise of retail media networks.
Like Amazon's ad business.
Exactly, which grew 23% year-over-year as retailers leverage their own customer data and e-commerce platforms to offer highly targeted advertising. And of course, the increasing influence of the creator economy, where individual creators are becoming powerful advertising channels, shifting ad dollars to new, more personal platforms. On a more structural note, there's a significant shift underway towards privacy-centric, first-party data solutions as the industry moves away from reliance on third-party cookies.
That's a big one. The cookie apocalypse.
It is a big deal, yeah. It forces advertisers and platforms to adapt their strategies, requiring more direct relationships with users and a focus on transparency.
While the digital advertising market clearly remains incredibly healthy, and its sheer size is astounding, it's important to note that the growth rates are expected to moderate somewhat from the post-pandemic surge we've witnessed.
Coming back down to earth a bit.
Kind of. We're likely to see a return to a more sustainable yet still very strong range of around 10% annually. This isn't a sign of weakness. It's rather a normalization after a period of accelerated digital transformation, but still offers a robust environment for companies like Alphabet.
Still double-digit growth, which
Yeah.
is great at that scale. And then there's the cloud computing market.
Right, the other huge growth engine.
Another critical growth area for Alphabet, especially through Google Cloud. This market reached $330 billion in 2024 and is forecast by industry analysts to grow a remarkable 19% in 2025.
19%. That's massive growth.
It is. Long-term projections are even more bullish, with the market expected to exceed an astonishing $2.2 trillion by 2032.
Trillion with a T. Wow.
This isn't just growth, it's an explosion. The primary catalyst for this immense growth is the immense demand for computing power needed to train and run increasingly sophisticated AI and machine learning workloads.
AI is fueling everything right now.
It really is. This trend is fueling a massive cycle of capital investment in AI-ready data centers by all the major cloud providers, a kind of digital arms race for AI infrastructure.
Yeah, the CapEx numbers are staggering.
What's also clear is that hybrid and multi-cloud environments are now standard for enterprise customers. Meaning businesses are distributing their workloads across different cloud providers and their own on-premise infrastructure to optimize for cost, performance, and redundancy. It's a pragmatic approach that requires cloud providers to be highly flexible.
You can't be locked into one vendor anymore. Now let's really dig into Alphabet's competitive positioning.
Okay, how do they stack up?
This provides an in-depth analysis of where they stand against their rivals across their core markets. In search, Google's dominance is truly unparalleled.
Almost a monopoly, really.
Pretty much. As of June 2025, its worldwide market share stood at a staggering 89.5%.
Wow.
To put that into perspective, its nearest competitor, Microsoft's Bing, held just 3.95% of the market. Other players like Yandex had 2.5% and Yahoo, 1.4%.
Bing is still under 4%. That's amazing.
Yeah. This leadership is even more pronounced on mobile platforms, where Google's share exceeds 93%. It's almost a de facto standard.
Right.
While this market share has been remarkably stable for a very long time, some data did indicate a brief dip below the 90% threshold in late 2024.
Oh, interesting.
A metric that absolutely warrants ongoing monitoring, just to see if there's any sustained shift, though it quickly rebounded. Still, something to watch.
Definitely. Okay, what about cloud?
Moving to cloud infrastructure, the market itself is effectively an oligopoly, tightly controlled by three main players.
The big three.
The big three. As of Q4 2024, Amazon Web Services, or AWS, was the undisputed market leader.
Still number one.
Followed by Microsoft Azure. Google Cloud stands as the clear number 3 provider, holding an 11-12% share.
Okay, number 3, but growing.
Exactly. What's notable here is that Google Cloud has consistently grown faster than the overall cloud market, indicating that while they are the number 3 player, they are actively gaining ground on their larger rivals, taking share in a high-growth market. It's a classic challenger story playing out in real time.
Making inroads. Good.
Then, beyond its core search business, In the broader digital advertising landscape, Google competes for advertising budgets with a very diverse set of platforms.
Right. It's not just Bing.
No, definitely not. This includes social media giants like Meta, which owns Facebook and Instagram,
Huge ad players.
and the incredibly popular short-form video leader, TikTok. We also had to consider the burgeoning retail media networks, led prominently by Amazon,
Yeah, Amazon's ad business is massive now.
which leverage their vast e-commerce data for targeted ads, essentially turning their checkout aisles into ad space. And then there are native advertising platforms such as Taboola. So while Google's search dominance is firm, the broader ad market is a much more fragmented and competitive space, where every major online platform is vying for ad dollars.
Lots of competition for those budgets.
To summarize, Alphabet is an entrenched incumbent in search, with near monopoly power and a fast-growing challenger in cloud, rapidly solidifying its position among the top global providers.
Defending and attacking.
It's almost like they're fighting battles on two very different fronts, defending a fortress in search and actively taking ground in the cloud.
That's a powerful duality.
Yeah.
So what does this all mean for the company's financial health?
The bottom line.
This is where the numbers really paint a clear picture of Alphabet's underlying strength and operational effectiveness, revealing how these market positions translate into real economic power.
Let's see it.
When we look at their revenue growth and profitability, Alphabet has a long and impressive track record of delivering robust top and bottom line expansion.
Consistent performers.
Very. Total revenues, for instance, expanded from $161.9 billion in 2019 to a substantial $350 billion in 2024.
Doubled in 5 years, basically. Incredible scale.
That's consistent double-digit growth year after year, a truly remarkable feat for a company of its size. During the same period, net income grew at an even faster pace, surging from $34.3 billion to an impressive $100.1 billion.
Wow, triple the profit. That shows leverage.
It really showcases the significant operating leverage they've achieved and a notable expansion in their profit margins. This strong performance has also continued into the most recent quarter. In Q1 2025, revenues increased a healthy 12% year-over-year to $90.2 billion.
Still double digits.
And their net income surged an even more remarkable 46% to $34.5 billion.
46% profit growth. Okay.
These aren't just big numbers. They represent sustained high-quality growth, proving that they can not only grow their top line, but also translate that into accelerated profits. Yeah. It's a masterclass in leveraging a mature cash cow-like search to fund the next generation of hyper-growth businesses like Cloud and Waymo, a dynamic few companies can replicate.
Elaborating on that point, the company's profitability profile has indeed strengthened considerably over the past 5 years.
You can see it in the margins.
Absolutely. If we look at the consolidated operating margin, it expanded from 21.1% in 2019 to 32.1% in 2024.
That's a big jump.
And in the first quarter of 2025, that operating margin reached 34%, an improvement from 32% in the prior year period. This expansion is driven by a powerful combination of strong top-line revenue growth and disciplined cost management across the organization.
Growth and efficiency.
Exactly. Now, a critical development and one that we touched on earlier is the profitability inflection point reached by Google Cloud.
Right, the big swing.
For many years, the segment was a significant investment area, incurring substantial operating losses that naturally weighed on Alphabet's consolidated results. However, as we discussed, in Q1 2023, Google Cloud reported its first-ever operating profit of $191 million.
The turning point.
Since then, its profitability has accelerated dramatically, reaching an operating income of $900 million in Q1 2024 and an astounding $2.18 billion in Q1 2025.
It's really contributing now.
This isn't just a minor improvement, it's a pivotal moment, validating the business model at scale and transforming the segment from a cash-burning venture into a self-sustaining, high-growth profit center.
Yeah.
As Google Cloud continues to scale its revenues, its improving margin profile is expected to become a material tailwind for Alphabet's overall profitability, significantly supporting a positive view of the consolidated business and its future earnings power.
So Cloud is helping overall margins now, not hurting.
Exactly. It truly demonstrates the company's ability to turn long-term investments into sustainable profit engines.
It's also important to understand that Alphabet is a prodigious generator of cash. I mean, just incredible amount.
A cash machine.
For the 3 months ended March 31, 2025, The company generated an incredible $36.2 billion in cash flow from operations.
$36 billion in
Ah!
3 months.
Wow. That's a truly massive amount of financial firepower. And management has a very clear three-pronged strategy for how they allocate this immense cash flow.
Okay, what do they do with it all?
First, and critically, is reinvestment in growth. The company is undertaking an aggressive capital expenditure program with planned investments of approximately $75 billion in 2025 alone.
$75 billion in CapEx. Mostly AI infrastructure, I assume.
Primarily, yes. Directed towards building out the essential technical infrastructure, things like servers and data centers that are required to support the exponential growth of AI services across all their segments. This isn't just maintaining status quo, it's investing for the future, building the very backbone of the AI revolution.
Fueling the future growth. Makes sense.
Second, they have a large and consistent share repurchase program. This is a way of returning capital directly to shareholders by buying back their own stock, which can boost earnings per share for remaining shareholders.
Standard practice for cash-rich companies.
Right. For example, they returned $15.3 billion to shareholders through repurchases in Q1 2025 alone.
$15 billion in 1 quarter.
Okay.
And third, signaling a new phase of capital return maturity, the company initiated a quarterly cash dividend.
Ah, the dividend. That was a big step.
It was. They declared a $1.21 per share dividend in April 2025. This action demonstrates a commitment to providing direct and predictable returns to shareholders, adding another layer of financial appeal and suggesting a confidence in sustained cash generation.
Yeah. It signals maturity and maybe attracts a different kind of investor, too. Looking at the balance sheet, it is exceptionally robust.
Rock solid.
Rock solid. This provides Alphabet with significant financial flexibility, which is crucial for a company of its scale operating in rapidly evolving markets. As of March 31st, 2025, Alphabet held $95.3 billion in cash equivalents, and marketable securities.
Almost $100 billion in cash.
A huge war chest, giving them immense strategic optionality. Their total assets stood at an impressive $475.4 billion against total liabilities of $150.3 billion, resulting in a formidable stockholders' equity base of $325.1 billion.
It's a very healthy balance sheet. Extremely. When you look at key credit metrics, such as their debt-to-equity ratio, they're extremely low, and liquidity ratios like the current ratio are very healthy, all indicating minimal financial risk.
Right.
This strong financial foundation allows them to continue their aggressive investments in AI and other growth areas without undue strain, essentially giving them a significant cushion against any unexpected market shifts or major capital expenditures.
That flexibility is key. To give you a snapshot of these trends, we can look at some of Alphabet's key financial metrics over the past 5 fiscal years, including the trailing 12 months leading up to Q1 2025. We're talking about total revenues, operating income, net income, diluted earnings per share, and their operating and net margins.
The trend lines tell the story.
Just looking at these trends tells a powerful story.
What these numbers clearly reveal are consistent trends. You see steady revenue growth, which then translates into accelerating net income, particularly in 2024 and Q1 2025.
That profit acceleration is noticeable.
Very. And this acceleration is accompanied by expanding operating and net margins, highlighting the underlying operational strength and efficiency that the company is achieving as it scales.
Getting more profitable as they grow.
Exactly. For instance, notice how net income growth was 35.7% in 2024, and then surged to an incredible 44.7% for the trailing 12 months ending Q1 2025. That's powerful.
Wow.
This isn't just about getting bigger, it's about becoming significantly more profitable as they scale, optimizing their vast resources and leveraging their market positions.
Right.
This financial strength is what allows them to make those massive investments we just discussed, particularly in areas like AI, without having to take on significant debt or dilute existing shareholders.
Okay, makes sense. Now let's talk about strategic direction, because management's stated priorities really revolve around its ambitious AI strategy.
It's all about AI now, isn't it?
It really is. This is truly the core of where they're heading, shaping every aspect of the company. Alphabet's overarching strategic priority is crystal clear. It's to build and deploy the world's most advanced, safe, and responsible AI.
The Gemini era.
Exactly. This is a period that management themselves refer to as the Gemini era, named after their flagship AI model family. And this strategy is being executed across 3 distinct layers of the AI stack.
Okay, the layers.
First, there's the foundational infrastructure layer, which includes developing their custom-designed tensor processing units, or TPUs,
Custom silicon.
and building out AI-optimized data centers. These are the literal engines powering their AI ambitions, the hardware that makes it all possible. Second, they're focused on developing world-class models, spearheaded by their Gemini family of models, which are the brains of the operation.
Right, the models themselves.
And third, they're integrating these powerful AI capabilities directly into their core products and platforms that billions of people use every day, such as Google Search, Google Cloud, Google Workspace, and Android.
Infusing AI everywhere.
Pretty much. What's brilliant here is how interconnected these layers are. The TPUs and data centers built for Google Cloud's enterprise clients are also powering the Gemini models, which then get integrated into your everyday search, creating a virtuous cycle of innovation and scale.
A flywheel effect.
Exactly. What's also key here is that this aggressive push into AI is being funded by a renewed focus on company-wide operational efficiency and disciplined resource allocation,
Cutting costs elsewhere to fund AI.
making sure every dollar spent is strategic and focused on this core priority.
To give you an even deeper dive into the Gemini era, Alphabet's AI strategy is incredibly comprehensive, aiming to infuse its most advanced models across its entire product portfolio.
So more on Gemini.
At the heart of this strategy are the Gemini family of models, which include versions like Gemini 2.5 Pro and the more efficient Gemini 2.5 Flash. What makes these models particularly significant is that they are natively multimodal.
Multimodal meaning text, image, audio, video.
Exactly. This means they are designed from the ground up to seamlessly process and reason across various types of data. Imagine an AI that doesn't just read your words, but also sees the pictures, hears the sounds, and understands the context from a video that's multimodal.
A more holistic understanding.
Right. Management positions this capability as a key competitive differentiator, allowing Gemini to understand and interact with the world in a more holistic way than many other models, opening up entirely new applications.
Okay, it makes sense. How about AI in search? That's the big question mark for many.
Right. In AI, in search, the company is pursuing a dual-pronged strategy for integrating generative AI into its core search product. On one hand, you have AI overviews.
The summary is at the top.
Exactly, which provide AI-generated summaries right at the top of results pages. These are being rapidly scaled to the entire user base, with the goal of enhancing the traditional search experience by providing quick, synthesized answers without you having to click through multiple links.
Trying to improve the core product.
On the other hand, they're rolling out AI mode as a more advanced, fully conversational AI experience.
Like a chatbot integrated.
Sort of, yeah. This is being offered to power users, allowing the company to innovate at the cutting edge with a truly interactive AI that you can chat with, almost like a personal assistant, without disrupting the core, established search product that serves billions and generates the vast majority of their revenue.
So testing the waters without breaking the bank.
Precisely. The rationale behind this dual approach is smart. It allows for rapid learning and iteration on new AI experiences, pushing the boundaries, while meticulously maintaining the stability and reliability of their primary revenue driver. They can experiment and push boundaries without risking their core business.
Hover. And for AI in the cloud.
For AI in cloud, the strategy is to establish Google Cloud as the premier destination for enterprise AI development and deployment.
The go-to place for businesses doing AI.
That's the goal. They're achieving this by offering superior AI-optimized infrastructure, which is crucial for businesses looking to build and run their own complex AI applications, ensuring they have the computing muscle they need.
The infrastructure piece.
They provide a broad selection of both first-party, Google's own, and third-party models through their Vertex AI platform, giving enterprises immense flexibility to choose the best AI tool for their specific needs.
Choice is important for enterprise.
Definitely. Additionally, they offer a suite of tools for building sophisticated AI agents that can automate complex business workflows, moving beyond simple chatbots to truly intelligent automation that can streamline entire processes.
AI agents doing real work.
Right. A recent important move in this strategy was the acquisition of cybersecurity leader Wiz.
Ah, yes, the Wiz deal. Big acquisition.
Very big. This acquisition is a key part of their plan, intended to provide a best-in-class, multi-cloud security offering, which is absolutely critical for enterprise customers who are increasingly operating across multiple cloud environments and need ironclad protection for their data.
Security is paramount for cloud adoption.
Absolutely. They're building a comprehensive ecosystem designed to meet the advanced AI needs of businesses, from infrastructure to security.
Okay, comprehensive strategy. Circling back to our other bets, let's talk more about unlocking value, specifically with Waymo.
Back to the cars.
As we mentioned, Waymo's transition from a long-term research project into a rapidly scaling commercial business represents a significant source of potential hidden value within Alphabet.
Yeah, the market might be undervaluing it.
This isn't just a speculative project anymore, it's proving its commercial viability in the real world.
Absolutely. After years of immense investment and meticulous refinement, Waymo has truly hit a critical inflection point in its commercialization journey.
That inflection point seems key.
It is. We already discussed the compelling data point that the service is now providing over 250,000 paid passenger trips each week. This five-fold increase from the previous year is a powerful testament to its strong product-market fit and its robust operational capability.
The growth numbers are hard to ignore.
They are. This isn't just about technology. It's about a functioning revenue-generating service that people are willing to pay for and rely on. This growth is being supported by an aggressive and clearly defined expansion plan.
More cities coming online.
Waymo is not only increasing its service areas within existing markets like Phoenix, San Francisco, Los Angeles, and Austin, making their autonomous ride-hailing more accessible, but they are also actively preparing for launches in new major cities.
Atlanta, D.C., Miami.
We're talking about significant urban centers like Atlanta, Washington, D.C., and Miami, which will dramatically expand their national footprint. And looking beyond the United States, Tokyo is slated to be its very first international market, a massive leap for the company.
Tokyo is a huge step.
This decisive shift from a pure R&D effort to full-scale commercial deployment fundamentally de-risks the Waymo investment. It essentially takes Waymo out of the high-risk moonshot category and plants it firmly in real business territory.
Less sci-fi, more business plan.
Exactly. The technology's viability in a commercial setting is increasingly proven. The primary variable now isn't whether it can work, but rather the pace of its deployment and how quickly it can monetize these rapidly expanding operations.
Execution risk rather than tech risk now, maybe?
Arguably, yes. This remarkable progress is transforming Waymo from what was once a highly speculative moonshot into a tangible business with a much clearer path to significant revenue and eventually profitability. This trajectory should compel the market to assign a more concrete and positive valuation to the other bet segment in the coming period.
So we've explored the inner workings, the vast markets, and the strong financial health of Alphabet. Now let's talk about navigating the road ahead.
Opportunities and risks.
Any major company faces a dual nature, immense opportunities for growth, but also potential headwinds that could impact its trajectory. What are the key factors that could really supercharge its value, and what are the biggest risks looming?
The catalysts versus the headwinds.
Let's start with the potential catalysts or value recognition, the factors that could lead to a more positive market assessment for Alphabet.
Okay, the upside drivers.
First, there's the successful monetization of AI in search. If we see clear evidence, maybe in financial reports or through management commentary, that the new generative AI features, like AI overviews and AI mode, are actually driving incremental query volume and, crucially, a higher return on investment for advertisers.
Proving it helps, not hurts, the ad business.
Exactly. That would go a long, long way to assuaging fears of revenue cannibalization from traditional search. Second, continued cloud margin expansion would be a huge catalyst.
More profit from cloud.
Quarterly results showing sustained improvement in Google Cloud's operating margin would demonstrate a clear path for that segment to become a major contributor to Alphabet's consolidated earnings power. Not just a growth story, but a significant profit center.
Solidifying its contribution.
Third, Waymo commercial acceleration. The achievement of key expansion milestones, for example, launching service in a major new city like Atlanta or D.C., or perhaps a large-scale partnership with a major automotive OEM for its technology.
A big Waymo partnership would be huge news.
Would definitely help to crystallize its standalone valuation and remove some of the moonshot uncertainty that still lingers for some investors. And finally, a favorable resolution to the ongoing antitrust remedies.
Ah, the regulatory overhang.
If the remedies imposed by the courts in the search and ad tech cases are primarily behavioral things like fines or changes to business practices rather than structural, such as forced divestitures.
Like selling Chrome, which the DOJ wants.
Right. If it avoids that, it would remove a significant overhang and likely lead to a positive re-rating of the stock.
Okay, those are some strong potential catalysts. Now let's look at the other side of the coin, the primary investment risks.
The potential pitfalls.
And frankly, the most significant and proximate risk facing the company is regulatory antitrust remedies. And this is a high risk factor.
The biggest worry right now.
I think so. Federal courts have already found Google liable for maintaining illegal monopolies in both the online search market, with a ruling in August 2024, and the digital advertising technology market in April 2025.
They already lost the cases, basically.
On liability, yes.
Yeah.
These cases are now in the remedies phase, which is where the courts will decide on the penalties. The Department of Justice has been advocating for severe structural remedies.
Like what, specifically?
This could include things like the forced sale of the Chrome browser or a ban on the incredibly lucrative default search engine agreements that Google has with partners like Apple.
Losing the Apple deal would hurt a lot.
Immensely. An outcome of this magnitude could fundamentally alter Google's business model and could negatively impact its long-term profitability in a very significant way. A ruling in the search case is anticipated as early as August 2025, so this is a very immediate and material concern, one that investors are watching extremely closely.
Very near term. Okay, what else?
Next, we have competitive GenAI disruption, which is a medium risk. The rapid rise of powerful conversational AI platforms presents a potential long-term disruptive threat to the traditional search advertising model that Google built its empire on.
People using ChatGPT instead of Google Search?
Potentially, yes.
Yeah.
Imagine a significant shift in user behavior from keyword-based search, where you type a query and get a list of links, to AI-driven conversations for information discovery and product research. If this shift happens broadly, it could erode the value of Google's core monetization engine, as users might bypass traditional search results entirely.
Right.
Now, Google is actively mitigating this risk by developing its own advanced AI search experiences, like AI overviews and AI mode.
Fighting fire with fire.
Exactly. However, the ultimate impact on user habits and, critically, on ad revenue remains a key uncertainty. No one knows exactly how this will play out in the long run, making it a nuanced but ongoing challenge.
A medium-term uncertainty. Got it.
Finally, there's macroeconomic advertising sensitivity, which we categorize as a low to medium risk. A substantial portion of Alphabet's revenue, particularly in the Google Services segment, is derived from advertising.
Ad spending follows the economy.
Precisely. Advertising, by its nature, is cyclical and sensitive to the broader economic climate. So if we were to see a significant global economic downturn, it would likely lead to reduced corporate advertising budgets across the board, which would then negatively impact revenue growth in Google services.
So a recession would hurt them?
It would likely hurt their growth rate, yes.
Yeah.
While this is a lower risk than the regulatory challenges, it's certainly a factor to monitor, as even a robust company isn't immune to broad economic shifts.
Makes sense. And sometimes when looking at a company like this, there are certain red flags that pop up in discussions that warrant closer examination.
Things that look bad on the surface.
Yeah. For example, you might periodically hear reports of stock sales by senior executives, like those disclosed in May and June 2025. It can make you wonder, are they losing confidence in the company's future?
That's a great point, and it's a natural concern. Insider selling always gets headlines.
It does.
However, a closer examination of these filings often reveals that these sales are part of pre-scheduled 10b5-1 trading plans.
The planned selling program.
Exactly. These are preset plans that executives establish months, sometimes a year, in advance to sell shares on a fixed schedule, precisely so they can't be accused of trading on insider information. It's just financial hygiene, not a panic button.
Okay.
The volume of shares sold is typically immaterial relative to the executive's total holdings, and certainly insignificant compared to the company's overall market capitalization. So these sales generally do not signal a change in corporate strategy or a lack of confidence from management. They're simply a predictable part of personal financial planning.
Good context. Another thing that sometimes gets highlighted is the significant layoffs the company conducted in 2023, impacting 12,000 employees.
Right, the big layoff round.
For some, that might raise a red flag about the company's stability or future.
While those actions certainly have a human cost, and it's important to acknowledge that.
Definitely.
From a business perspective, they were part of a broader trend seen across the entire technology industry in response to a changing macroeconomic environment.
Everyone was doing it back then.
Pretty much. Many tech companies adjusted their headcounts after rapid expansion. From an investor perspective, These moves actually reflect a commitment to operational efficiency and cost discipline.
Trimming the fat, essentially.
Essentially, yes. These reductions free up capital to be reinvested in strategic, high-priority areas, particularly in the massive push into artificial intelligence. It was a strategic reallocation of resources, not necessarily a sign of distress, indicating a focus on lean operations and funding their most important initiatives.
Okay, so maybe not a red flag in itself. Let's unpack this from a valuation perspective. What is the market currently saying about the company's value, given everything we've discussed?
The million-dollar, or rather trillion-dollar question.
Right. The Wall Street analyst community, by and large, hold a strongly positive view of Alphabet's stock. Consensus ratings from multiple data aggregators are overwhelmingly buy, or strong buy.
The Street likes it.
Very much so. To give you some compelling statistics, out of 53 analysts tracked by one source, 45, that's a whopping 85%, recommend buying the stock.
85% buy ratings. That's high.
It is. There are only 8 hold ratings and, crucially, 0 sell recommendations. Now, the range of individual analyst views can be wide, reflecting differing perspectives, especially on potential regulatory outcomes, but the overall sentiment is undeniably bullish.
Yeah, despite the risks, analysts are positive overall.
It's rare to see such a strong consensus.
An analysis of Alphabet's valuation multiples relative to its own history and its peers suggests the stock is, arguably, attractively priced right now.
Okay, so it looks cheap compared to history.
Potentially, yes.
Yeah.
Let's look at some specifics. Its trailing 12-month, or TTM, price-to-earnings PE ratio, which was approximately 21x as of July 2025.
21 times earnings. Okay.
Represents a notable discount to its 10-year historical average PE, which is about 28x.
So normally trades closer to 28x.
Historically, yes. The PE ratio, especially TTM, is a key way we assess how much investors are willing to pay for each dollar of a company's past earnings. Lower can mean cheaper. Higher can mean growth expectations are sky high.
Right.
In this case, it appears cheaper by its own historical standards. It's also trading below its more recent 3-year average of around 22x and its 5-year average of approximately 24x.
Cheaper than recent history, too.
Similarly, its TTM enterprise value to EBITDA ratio, which stands at approximately 15-16x, is below its 5-year average of roughly 18x. This metric is often used for valuing businesses, considering both debt and cash, and it too suggests a discount.
Multiple metrics pointing to a discount versus history.
And when we compare its valuation to other Magnificent 7 megacap technology stocks,
how does it look versus peers like Apple, Microsoft?
Alphabet's TTM PE ratio of roughly 21x is considerably lower than that of Apple, which is around 33x, Amazon at about 36x, and Microsoft at approximately 39x.
Wow, quite a bit lower than those giants.
It really reinforces the view that it stands out as one of the more attractively valued names within that elite peer group, especially considering its robust financial performance and growth opportunities. So combining these points, the company's valuation appears quite reasonable and potentially quite appealing, given these comparisons. It seems the market is already baking in a significant amount of the potential risks we discussed.
Pricing in the regulatory fear, perhaps?
Arguably, yes.
And when you look at independent assessments of intrinsic value, like Morningstar's fair value estimate of $237 per share, they also indicate that the stock is currently undervalued.
So third-party analysis agrees.
Seems so. This valuation discount relative to its own historical multiples essentially provides what we call a tangible margin of safety for those looking at its long-term potential.
A buffer against things going wrong.
Right. It suggests that the current market valuation appears to be factoring in a significant degree of regulatory and competitive risk, perhaps more than warranted, leaving room for a potential reevaluation.
If we connect this to the bigger picture, it really paints a comprehensive story. Should the company successfully navigate these challenges, particularly the regulatory ones, and continue to execute on its ambitious AI and cloud strategies?
Big ifs, but possible.
There is significant potential for its valuation multiple to expand back toward its historical average. This, compounded with underlying earnings growth, would create substantial value.
Multiple expansion plus earnings growth. Powerful combo.
This company is a high-quality, wide-moat business, arguably positioned to be a primary beneficiary of the AI revolution.
Strong core business.
Its core search business remains dominant and highly profitable, generating the immense cash flows that fund these critical investments. Those investments, in turn, are establishing Google Cloud as a powerful number 3 player in an oligopolistic market and Waymo as a clear leader in the burgeoning autonomous driving space.
Solid growth engines, too.
While significant regulatory risks certainly persist and demand close monitoring, the current valuation, trading at a discount to both historical norms and key peers, presents a compelling picture for its future trajectory.
Compelling.
This suggests a very favorable risk-adjusted return profile over the coming period, driven by continued earnings growth and the very real potential for a reevaluation of its stock as its AI initiatives bear more fruit and hopefully as some of that regulatory uncertainty begins to subside.
So potentially an attractive setup despite the risks.
It's a company with strong fundamentals, trading at a relative discount, which could make it quite appealing.
So after this deep dive, what does this all suggest to you about the future of tech giants in an AI-powered, highly regulated world, especially given the dual pressures of innovation and scrutiny?
Yeah,
It truly highlights how delicate that balance can be.
it absolutely does. It highlights the continuous evolution of companies of this scale. They are never static.
Constantly changing.
There's this fascinating interplay between relentless technological advancement, the ever-shifting market dynamics, and the increasingly complex regulatory landscapes they must navigate.
Juggling innovation and regulation.
Their ability to innovate at lightning speed while also responding thoughtfully to societal and governmental demands will truly define their long-term success, and it's a tightrope walk that's constantly being observed.
Absolutely fascinating. The sheer complexity these companies juggle, from innovation to regulation, really is something. That's all the time we have for this deep dive into Alphabet.
It flew by.
It did. We hope it's given you a clearer, more nuanced understanding of this incredibly influential company. We encourage you to continue your own exploration of these vital topics. Until next time, keep digging deeper.